Hello, I'm Annabel Brodie-Smith, Communications Director of the Association of Investment Companies. It's been a milestone year for the investment company industry. 2018 saw the 150th birthday of the first investment company, and the industry's assets reached an all-time high of 189 billion. And despite bouts of market turbulence, the average investment company has returned 1.3% to the end of November, outperforming a loss of 2.6% for the average open-ended fund and a loss of 6% for the FTSE All-Share. However, with the threat of trade wars and concerns over global growth looming large, there are certainly threats which could be worrying investors for 2019. To discuss the outlook for the year ahead, I'm delighted to be joined by Simon Edelsten, Fund Manager of Wynd International from the global sector, Jean Roche, Co-Manager of Schroder UK Mid-Cap in UK All Companies, and Peter Spiller, Manager of Capital Gearing in the flexible investment sector. On to the questions. What are the key reasons for optimism in 2019, Simon?
So the Wynd Investment Trust is a global equity fund, and we try to run it in a cautious manner. It's a long-only equity fund. So 2018, the year we're just coming to the end of, we were very worried that the US might overheat. We could see that US bond yields needed to go up because there was a ever-present risk of inflation kicking in, and that was well commented on a year ago. And lo and behold, we've had a very high level of American growth all year, nearly 4% GDP growth, but actually inflation hasn't come through. So funnily enough, when we're looking towards 2019, what we find is, okay, the US economy is going to be growing more slowly. The risk of inflation, which we always have in mind, has been much less of a danger than we expected. Bond yields haven't had to go up quite as much as some people feared, which normally puts pressure on all equity markets and equity valuations in all. And so we find ourselves with some of our growth stocks actually a year on, producing more cash flow. Share prices are down on a year ago, and so obviously that's better value for money. That being said, the later you are in the cycle, and with very large capital gains out there amongst our investors to protect, we're carrying on running a fairly cautious attitude to investment, and a much more balanced fund than we've run for a few years, just because the bull market is quite old, and the total amount of government debt in the world, of course, is very, very large indeed. And one is seeing something of a slowdown in America, but really quite a bad slowdown in some emerging markets in Europe. So cautious optimism in some sectors. We try to punt those sectors down, concentrate the growth part of our portfolio on that. But otherwise, it's a good year in our mind not to be too greedy and try to run a balanced fund.
Okay, some cautious optimism there. Jean, what are your views on optimism for 2019?
Yeah, well, you might be surprised to hear that even though I run a UK mid-cap investment trust, I'm also feeling cautiously optimistic. Despite the barrage of negative political headlines, I think that we've been wise to really look at some of the data around things like the UK consumer, which has kept on spending, and to try and look for the areas where they are spending, and look for areas of market disruption, such as in restaurants, in high street retail, and look for investment opportunities there. The UK market is historically cheap, and I think that's a reason to be cheerful as an opportunistic fund manager, looking for areas to invest in that might be underpriced. So I think, with next year we should get more clarity in 2019 on the political situation, which will help sentiment, and that should mean that some of the opportunities that we're taking now should bear fruit.
Great. Well, UK is undervalued. Hopefully those opportunities will pay off next year. Peter, are there any reasons for optimism in 2019?
Well, you're quite right to ask the question, because we are more defensively positioned than we have been ever, actually, in the last 36 years. But the element that I would point to, for some hope anyway, is that people have become very gloomy. So everybody now thinks there's going to be a recession next year in America. The numbers, in fact, are absolutely fine. The PMIs suggest quite powerful momentum into that year. And the same thing in Europe. We are looking at, obviously we've had negative rate of growth in large parts of Europe in the third quarter, but it is unlikely that that will continue into the fourth. And finally, markets have been very sensitive to tariffs. And who knows what Trump will do, but there must be some optimism that he will end up with a situation where he feels he's won, in quotation marks, and then world trade might start to expand again.
Right. Well, then what are the key reasons for concern in 2019, Peter?
Well, that's a much longer list. But the key concern is the level of debt, which Simon's already alluded to. And we just don't seem to have found a model where we can grow economies without debt expanding. And the consequence of that is, in the end, that we're going to require inflation to get rid of that debt as a percentage of, or reduce it as a percentage of assets and incomes. But that may not happen in 2019. We make no predictions at all about the short term. And I would call the whole of 2019 a short-term prediction. But we're pretty convinced that the distortions which QE has introduced to the price of all financial assets will in the end be reversed. And we worry a lot that when that debt starts to fall, central banks will be very poorly placed to deal with it and will have to be very radical when it comes.
Right, well, definitely something to think about there. Jean, your key concerns for 2019?
I think what we'll be doing is looking again at all of our companies' balance sheets, making sure that they're not overly levered, or that they're generating enough cash flow to delever, and protecting ourselves in that way. I think politically, you might say, as well as there could be resolutions to what's going on in 2018 and the whole Brexit process, there could also be a new government in 2019. So we have to consider what that might bring and position ourselves, and with that in mind also. So, areas for concern or areas where we need to be nimble, I would say.
Yeah, well, it's been a political minefield here in the UK, but hopefully we'll get some clarity on that in 2019. And Simon, what are your key concerns for 2019?
Well, I think just to enlarge on a couple of the points already raised, the biggest worry we have running a global equity fund is trade, by and large, and trade disputes came before major stock market crashes, 1929, 1971, both of these had trade disputes, and often trade disputes in a world where currencies were fixed. Now, of course, most currencies are not fixed. The dollar can be printed by the American government, the sterling can be printed by our government, but of course the Italians can't print euros without talking to the Germans first. So it's that combination of fixed currencies and disrupted international trade arrangements which is the most worrying thing, apart from inflation, which we always try to keep an eye on. So I hope Peter's right that Donald doesn't play his cards too hard and end up with a bad deal or no deal with the Chinese. Temperatures certainly still seem to be getting worse as we stand at the moment. I don't think it's right to assume that he'll do the right thing.
In our AIC Fund Manager poll, the managers thought the greatest threat was trade war.
Yeah.
So I think that chimes with your thoughts there. And looking towards next year, which regions and sectors do you think will be the greatest winners and losers?
Well, oddly enough, one of the biggest allocation to a long-term growth opportunity that we have in our portfolios for the last couple of years has been automation. And one of the surprising things that's come out of our analysis of how people respond to trade wars is we've gone and talked to multinational companies and said, what are you going to do about these plants you've built in emerging markets over the last 20 years, 25 years, to make components for your product more cheaply, often to very good quality? And they said, well, of course, when we built our plant in Thailand or Mexico 20 years ago, we built it when labour was very cheap and expensive in America or whatever, or expensive in Germany even. So we built a plant with fairly high labour content. Now labour has become quite expensive anyway. Wages in these countries have gone up quite rightly. And so it's very easy for us to increase the amount of automation. So I'm afraid one of the consequences of the trade war probably will be companies will automate more. They will create fewer jobs in emerging markets, which is not necessarily great for emerging markets. One of the consequences will not be that they'll close the plant and go and open a plant in Ohio or somewhere. You know, this promise that Trump's made that the jobs will come back to blue-collar America is almost certainly completely fatuous. But it could be very good for our automation shares, which, interestingly enough, have been the worst performing part of our portfolio this year, because all these decisions to automate have been put off by companies. But we think the longer term story, ironically, is stronger than ever.
Okay, well, we'll see if that's right. Jean, Brexit is clearly a big consideration. How are you approaching this within your portfolio?
Well, it might seem a little bit counterintuitive, and you know, the tendency might be to avoid UK-facing companies and companies that are more dependent on the consumer, for example, in the UK for their profits. But actually what we found to be a very good way to position ourselves post the Brexit vote was to actually buy some of those house builders which had been very weak, to look at those retailers who were responding to online disruption, and also to look at, say, restaurant companies, for example, which are using technology cleverly. So that's where some of our investments can lie. We're very fortunate, though, in that our mid-cap index in the UK has 50% of its revenues generated outside the UK. So we have a menu to choose from for UK. Some companies completely UK focused, some with 90% or more of their revenues outside the UK. So, you know, I don't want to name certain companies, but, you know, there are areas where we can look at in the UK domestic basket, which we feel are oversold and which offer good value. So that's how we will position ourselves in those companies that we know well, where we think that there's demand for the product still, despite the fears that surround the domestic economy.
Well, we're not going away here in the UK, are we? So some of us are still going to be out there shopping and going to restaurants. I'm sure that's going to be the case in 2019 even. Peter, there are clearly threats facing investors at the moment. How are you positioning your portfolio?
Well, the first thing to do, if the outlook for returns is poor and the outlook for risk is high, is to shorten duration, to tie that exposure to those forces in for as little as possible. But there are some asset classes which look quite interesting. So, as mentioned earlier, the one difference that we have, or major difference that we have with the market consensus, is that we think inflation will build, not explode, but build gently, at perhaps 1% a year over the next year, and subsequently, so long as the American economy keeps going. The market is not pricing in anything. So the implicit market forecast from the break-evens is that inflation will never meet the target set for the Fed over 10 years or over 30 years. So if we're right, then that will be a surprise in more than one sense. But it does suggest that there is opportunity in inflation-protected securities in America, TIPS, as they're known. And we expect significant capital gain as well as protection from the inflation that would engender.
Right, well, we'll see how that works. Jean, what is most important for your company in 2019?
I think the most important thing is that we buy the right stocks at the right price. We look at a method of investing called GARP, growth at a reasonable price. And that's something I will be looking at very carefully and making sure that the forecasts for certain companies are still where we think they should be, and that makes sense. I think also not being distracted by political noise will be extremely important for me as a mid-cap UK investor. And you know, that's something that one always has to work on, because there's always a new headline popping up on your phone or on the screen. So I think that's, you know, staying focused, keeping our eyes on the individual companies, and not being distracted will be the most important things for us in 2019.
I think we could all be distracted by the negative news at the moment, but yeah, that's a good thing. Keep focused. Simon, what's important for your company in 2019?
I think much the same. If the trade dispute quietens down, or even looks as though it's heading for some sort of resolution, we think most of the companies we invest in have well-formed plans. They just haven't signalled go yet. They're waiting for the uncertainty to reduce a little bit, and so I don't think it would take much of a reduction in the political headlines for companies to get on, put their longer-term investments in place, and that should do a lot of the stocks that we put in the portfolio a huge amount of good, particularly at the valuations that they're now trading on.
Right, so they've got to get on with it.
Yep.
Peter is, I have to say, is our longest serving manager in the investment company industry at 36 years. Very interested to know what's most important for your investment company in 2019.
Well, I think there are two things. One which hasn't been mentioned yet is liquidity. Liquidity has been more challenging on a continuing basis for the last 10 years. And I think that there will be a lot of opportunities to buy assets from distressed sellers when we get a bear market. And therefore it's very important to have dry powder that is available to take advantage of those opportunities. But more generally, the outlook is such that by far the most important thing for us is to make sure that our clients' capital is maintained in real terms after costs. It is not a time to be ambitious. There have been times to be ambitious. Back in the 80s, when we were making close on 50% returns in a year, that was fun. But now is not such a time. Maybe we'll get back there.
So capital preservation,
Capital
basically.
preservation is key.
But all of you focusing on opportunities too, as they come available. Right, well, I'd very much like to thank our managers for joining us today. It's great to hear their views on the outlook for 2019, but I'd like to emphasise we don't know what's going to happen in the future. Investment is for the long term, and it's important to have a well-balanced portfolio. If you are in any doubt, you should talk to a financial advisor. All that remains is for me to wish you a very Merry Christmas and a Happy New Year. Thanks so much for watching.